Patience is a word every trader loves to use. Ask almost any trader what the most important skill in trading is, and patience will always appear somewhere on the list. Everyone agrees that patience matters. Everyone believes they understand it. Everyone assumes they already possess it. But the strange truth about patience is this: it only reveals itself in the exact moment when it is hardest to practice. When the market is quiet, patience feels effortless. When nothing is moving and no trades are available, it is easy to say, "I will wait for the perfect setup." It is easy to promise yourself that you will follow your rules and remain disciplined. But then, the market begins to move. The candles start printing quickly, price accelerates, momentum appears. Suddenly, the chart feels alive. And in that moment, something changes inside your mind. What felt calm a few minutes ago becomes urgent. Every candle looks important, every breakout seems meaningful, every movement feels like the beginning of a massive opportunity. And now, patience is no longer a simple idea. It becomes a struggle, a conflict between logic and impulse, a conflict between discipline and emotion, a conflict between the trader you want to become and the habits that still control your decisions. This is the moment where most traders discover something uncomfortable. Patience is not a natural skill. It is a trained mindset, and mastering it can completely transform the way you experience the market. Why the market creates impatience. To understand patience in trading, you first need to understand something about human psychology. Your brain evolved to react to movement. Thousands of years ago, movement in your environment often meant something important. It could mean danger. It could mean opportunity. It could mean survival. So your brain learned to respond quickly. When something moves, your brain tells you to act. But financial markets are very different from natural environments. In the market, movement does not always mean opportunity. Most of the time, movement means noise. Charts are constantly fluctuating because thousands of participants are buying and selling simultaneously. Short-term movements can be random. Liquidity gets taken. Orders are filled. Algorithms adjust positions. And as a result, price moves constantly. But just because price is moving does not mean a trade is present. Unfortunately, the human brain does not easily accept this. It sees movement and assumes action is required. This is why patience is so common among traders. It is not just a trading problem, it is a human problem that becomes amplified in the trading environment. The market moves quickly, and your instincts push you to react quickly. But successful trading requires the opposite response. Instead of reacting faster, you must learn to react slower. The expensive habit of entering too early. Almost every trader has experienced the same frustrating scenario. You analyze the chart and identify a potential setup. You believe the market is about to move in a certain direction. Then, price begins to move slightly in that direction, and at that moment, a thought appears in your mind. What if the move starts without me? This thought creates urgency. You begin to imagine the market moving quickly while you sit on the sidelines. You picture the opportunity disappearing, and suddenly waiting feels more dangerous than entering early. So you take the trade. But then something happens. Price pulls back. Your stop loss gets triggered. You exit the trade with a loss. And then, moments later, the market moves exactly in the direction you originally predicted. This situation frustrates traders deeply because they were not wrong about the direction. They were simply early. And being early can be just as costly as being wrong. Entering too early places your trade inside the most dangerous area of the chart, the uncertainty zone. This is the area where the market often performs liquidity grabs. It is where fake breakouts occur. It is where price creates wicks that remove traders before the real move begins. Impatient traders enter during this chaos. Patient traders wait for the chaos to finish. And that difference alone can dramatically improve trading performance. The illusion of urgency. One of the most powerful psychological traps in trading is the illusion of urgency. The market has a unique way of creating the feeling that you must act immediately. A strong candle appears, momentum builds, volume increases, and suddenly it feels like something important is happening right now. Your mind starts telling a story. This could be the breakout. This could be the move of the day. If I don't enter now, I'll miss it. But the truth is that markets create these moments constantly. Today's breakout is rarely the last opportunity. Tomorrow will create new setups. Next week will bring new trends. The market is an endless generator of opportunities, but traders often behave as if opportunities are rare and fragile. They rush into trades because they believe the moment will disappear forever. Ironically, this urgency often pushes them into the worst possible entries. The patient trader understands something different. They understand that missing a trade is not a failure. Taking a bad trade is. Patience reveals the truth behind price movement. When you slow down and allow time to pass, something interesting begins to happen. The market reveals more information. What looked like a breakout a few seconds ago might reveal itself to be a fake move. What looked like strong momentum might suddenly stall. What appeared to be a trend might transform into consolidation. Patience allows the chart to tell its story, and this story is often very different from the first impression. Markets rarely move in straight lines. They test levels, they collect liquidity, they trap impatient traders, they create hesitation before committing to a direction. When you wait, you begin to see these patterns more clearly, and this clarity makes your decisions far more confident. The emotional cost of impulsive trading. Impatience does not only damage your account, it damages your emotional stability as well. Impulsive trades create stress. You watch every candle nervously, you question your decisions constantly, you react emotionally to every pullback. Trading becomes exhausting. But when you enter trades after patiently waiting for confirmation, the emotional experience changes. You feel calmer, you trust the setup more, you feel aligned with your plan. This difference may seem small, but it has enormous consequences.
A calm trader manages trades logically. An anxious trader manages trades emotionally. And emotional trading almost always leads to mistakes. Patience as psychological risk management. Risk management is usually discussed in terms of numbers, position size, stop-loss placement, risk-to-reward ratios, but there is another form of risk management that is rarely discussed: psychological risk management. This is the ability to protect yourself from emotional decisions. Patience plays a crucial role in this. When you wait before entering a trade, you create space between impulse and action. This space allows logic to intervene. You ask better questions. Is the setup valid? Is the risk acceptable? Is the market structure clear? Without this pause, emotions take control. Patience is essentially a filter. It removes many bad trades before they ever happen. The market as a psychological test. One of the most interesting aspects of trading is that the market constantly tests your psychology. It tests your patience, it tests your discipline, it tests your emotional control. The market might create a sudden spike just to see if traders chase the move. It might produce a false breakout just to trap impatient participants. It might consolidate for hours just to exhaust traders who need constant action. These situations are not random, they're part of the structure of the market. And traders who cannot control their impulses often fall directly into these traps. Patience is what allows you to pass these psychological tests. When you refuse to react emotionally, the traps lose their power. Learning the rhythm of the market. Markets move in cycles. Momentum appears, then momentum fades. Trends form, then consolidation begins. Liquidity is taken, then direction becomes clear. When traders slow down and observe patiently, they begin to recognize these rhythms. Trading starts to feel less chaotic. You start understanding how price behaves around key levels. You recognize when the market is building pressure for a move. You identify when momentum is weakening. These insights are almost impossible to notice when you are constantly reacting. Observation requires stillness, and stillness requires patience.
the long-term power of patience. Trading success is not built from one perfect trade. It is built from thousands of disciplined decisions. Every time you resist an impulsive trade, you strengthen your discipline. Every time you wait for confirmation, you reinforce your strategy. Every time you follow your plan instead of chasing the market, you improve your consistency. These moments may seem small, but over time they accumulate. They shape your habits, they transform the way you think, and eventually they reshape your entire identity as a trader. You no longer feel pressured to act constantly. You become comfortable waiting, and that comfort creates a powerful advantage because the majority of traders cannot wait. Patience and emotional neutrality. One of the greatest benefits of patience is emotional neutrality. When traders become impatient, their emotions swing constantly. A small profit creates excitement, a small pullback creates fear, a sudden movement creates panic. Their emotional state becomes tied to every candle. But patient traders experience something different. Their emotions remain stable. They understand that price fluctuations are normal. They allow trades to develop naturally. They do not react to every small movement. This emotional neutrality allows them to think clearly even during volatile conditions, and clear thinking leads to better decisions. Patience changes your relationship with time. Many beginner traders believe that time is their enemy. They feel that every moment without a trade is wasted. They think success requires constant activity. But experienced traders see time differently. Time is information. Time reveals structure. Time confirms momentum. Time exposes fake movements. When you allow time to pass, the chart becomes clearer, and clearer charts lead to smarter decisions. Time helps patient traders, but it punishes impatient ones. Final thoughts: the true meaning of patience. Patience in trading is not about sitting and doing nothing. It is about choosing the right moment to act. It is about understanding that the market moves in its own rhythm. It is about accepting that not every movement deserves your attention. Most importantly, patience is about mastering yourself, because the real challenge in trading is not predicting the market. The real challenge is controlling your reactions to it. When you develop patience, everything begins to change. Your trades become more selective, your emotions become more stable, your decisions become more logical, and over time, your results begin to improve. Patience is not a shortcut to success, but without it, success in trading is almost impossible. Outro. Every trader eventually learns this lesson. The market rewards those who wait. It rewards those who observe, and it rewards those who remain disciplined when others react emotionally. Patience is not just a skill, it is the foundation of consistency. And the moment you truly understand patience is the moment your trading journey begins to change.